Now, for more on this, let's cross to the newsroom because we have our business reporter there, David Waddell. David, could you just put all of this into context for us?
I'll do my best. So we're looking here at the third month in a row of interest rates staying on hold where they are. I can bring up this graph which shows where interest rates have been in recent years. For a long time here, for many years, back since 2009, they've been hovering beneath 1%. In recent times here, 0.1%, incredibly low, historic low interest rates. And then almost to the day, 2 years ago, they started to rise, tracking this path from 0.1% all the way up to 5.25%, which is where they are now. So they've been at that rate for the past 3 months. And the expectation now, as you've been hearing, is that at some point in the year ahead, they will fall, perhaps fall 3 times or 75, maybe 100 basis points between now and the end of 2024.
Could you just also explain to us what this actually means for day-to-day life, depending on people's personal situations?
So the impact for most consumers, for householders, those who own homes, is that if they have a mortgage, and not everyone does, then it will have an impact on what they pay for their mortgage rates. Now, many people, most people in this country certainly, when they have a mortgage, they have it on a fixed rate, perhaps for 2 years or 5 years. So many of the people who are on a fixed rate mortgage for 5 years, I, for example, came off my own 5-year mortgage in April and had to remortgage then. I'm not affected by this for 5 years because I need to wait until then before I've got a chance to remortgage. But many people will be. My understanding is that 1.6 million mortgage holders will have their mortgages up for review in the next 12 months. So those people will be affected by any further changes to the interest rate in the months ahead.
And David, this comes off of the back of the US Federal Reserve decision yesterday. Could you give us a bit of a global comparison?
Yeah, absolutely. So one of the factors coming out of the Federal Reserve's announcement is the suggestion that they've made for the first time that they would be cutting or would expect to cut rates in the year ahead. Now, while that was widely expected, that hadn't been formally acknowledged until now. So that's having a wider reverberation upon people's expectations about the ECB decision, expected in just over an hour's time, and also in the Bank of England rate decision that we've just heard, and the expectations for what we'll have in the coming months. Let's just move you on to this next graph. We've seen interest rates around the world, particularly in these developed Western economies, the UK, the US and the EU. Here are these 3 lines. So the US is here, the red line, just below the UK's interest rate. The euro area interest rate is essentially at 4%. The US is just here, just below the UK's rate at 5.25%. So they've all been rising. And the expectation is not that they'll fall to these terribly low levels, but that in due course over the next 12 months they will fall somewhat.
Let's cross back to David, who's in the newsroom for us. And David, you've been monitoring some of the reaction coming in.
Well, I've just got a little bit more detail from the Monetary Policy Committee minutes, so I'll just say this. We did hear already that some of the committee were voting for a raise. Some were voting to keep the rates on hold, and no one was voting to cut the rates. So I can say from the statement, they've said monetary policy is likely to need to be restrictive for an extended period of time. The Bank of England Governor Andrew Bailey said there's still some way to go on inflation. We will take the decisions necessary to get CPI all the way back to 2%. Now, it's well above 4% at the moment. In recent months it was as high as 11%, so it has fallen some way. It's fallen by more than half, but it needs to fall by more than half yet again to get under the Bank of England's target of 2%, between 0 and 2%. So that's just a little further detail, because I think there is a lot of talk that rates will fall in due course, and of course that may still happen, but the Bank of England very keen to steer us away from suggestions that it's keen to cut interest rates very soon.
Right, and David, could you give us a bit of an overview again, because we've talked recently just about how they've been making this decision in terms of 3 members who disagreed with the decision. Could you explain how that committee actually works?
Yes, well, they have to make a decision where their focus is to keep the target inflation, the CPI, consumer price inflation level, somewhere between 0 and 2%. Now, it's above that. So a simplistic argument would take you to the place that we should keep raising interest rates higher and higher until inflation falls to 2%. The problem with that is that these things take time, and the interest rate needs to be managed for the future, not just for today.
Right. David, thank you so much.